Increase that to $10 a month, and it grows to about $53,000. And if you can invest $1,000 a month, that's roughly $5.3 million. So if I only had $1 to invest right now, I get started, and as my income grows, I'll add more to say $2, $3, then $10, and before long, my investments will grow exponentially. So, with all that background, you now know everything you need to make your first investment. So, if I were to start all over again, the first thing that I would do is open a brokerage account, which is basically the platform that allows you to buy and sell investments like ETFs, stocks, and bonds. Now, if you decide to invest in something like an ETF, just know that each ETF charges a small annual fee for managing your investments. This is known as the expense ratio. And basically, when you have this ETF, you'll have to pay a percentage of the total amount that you have actually invested. For example, if you invest $1,200 a month, that adds up to $14,400 over a year. If your ETF charges a 0.05% expense ratio, you'd only have to pay about $7.20 in fees for that year. But if it charged 1%, then you'd be paying around $144 instead. And this difference in expense ratios actually compounds a lot over time. So for me and my personal rule, I usually choose expense ratios under 0.5%. Anything higher than 0.5% for me, I think it's just way too high. I would stay away from them. Now, there are a lot of funds that have low expense ratios like QQQM, SPYM, and FZROX, which actually has a 0 expense ratio. So, for today, I'm going to show you how to make your first investment through Fidelity, which is the brokerage that I personally use. First, I'll start by typing Fidelity into my browser, clicking through their website, and selecting Open an Account. From there, I'll fill in my personal details such as my name, address, social security number, and contact info. Brokerages collect this information because they're required by law to verify your identity and report your investment income to the IRS for tax purposes. Now, once that's done, I'll choose what kind of account I want to open. There are two main types. Most beginners look at a Roth IRA or a regular taxable brokerage account. For a Roth IRA just basically stands for an individual retirement account. You can contribute money into it, let it grow tax-free, and when you withdraw later at 59.5, all of that money is going to be tax and penalty-free. And as I'm recording this right now, and it's not actually confirmed, for 2026, the IRA contribution limit steps up to $7,500 for people under 50. And if you're older than 50, that goes up to $8,600 a year. Again, these numbers might change, but it's always a good idea to check yourself on irs.gov. Now, the second account is a taxable brokerage account. With this account, there is no contribution limit, and you can withdraw your money at any time. The only downside to this account is, well, it's built within the name that you actually have to pay taxes on any profits or dividends that you earn. So for this video, I'm going to open a Roth IRA because it's a great way to take advantage for long-term tax-free growth. Now that the account is open, I'll move over to the dashboard and click on Transfer so I can link my bank account and deposit the money I want to invest. You can kind of think of the Roth IRA as your shopping cart and the ETFs you buy as the items that you're putting inside of it. Once the money is in, I'll go to the Quote section and search for the ETF I want to invest in. Today, I'm going to choose SPLG, which is now renamed to SPYM, and it's trading at around $80 per share. If I'm using a Roth IRA, I'm limited by an annual contribution, so I might invest only $1,000 this month. But just to keep things simple, I'll just say that I want to invest in one share of SPLG or SPYM. Next, I'll click Buy under Action and choose Market Order as my order type. A market order just means that I'm buying it at the current price, so it'll go through immediately. You can also use a limit order if you only want to buy if the price drops to a certain point. But for long-term investors, a market order works perfectly fine. Finally, I'll make sure that everything looks okay, then I'll hit Submit. And really, that's it. I just made my first investment in less than 5 minutes, which means that you can pretty much do the same exact thing too. Now that I made my first investment, and hopefully you have too, there are a few simple strategies that I want to leave you with. First, with all of the students that I work with, I usually have them automate their investing. You probably heard people say, pay yourself first, and that's exactly what this means. You can kind of think of yourself as a small business. You earn income, you pay your bills, and you need to pay your employees, which in this case, it's you. Adding money to your investment is your salary for your future self. And just like you never skip paying your employees, you don't want to skip investing either. The easiest way to make sure that it actually happens is to automate it. You can choose a comfortable amount and set it as a recurring debit order. This way, you don't have to think about it or rely on your willpower. You'll just know that every month you're paying yourself and steadily building wealth. Second, and this is a big thing for all beginner investors, you want to avoid selling when the market dips. So let me show you what I mean. If you invested in something like IVV, your portfolio would have grown nicely until 2020 when the pandemic hit. Here on the graph, you can see how that big drop just suddenly happened. And in moments like this, it's easy to panic and sell, thinking that you're protecting yourself from bigger losses. But if you'd sold, you would have missed the rebound that followed. Within a couple of years, markets had not only recovered, but also reached a new all-time high. In my experience, it's far more profitable to stay invested through the ups and downs. Most well-known ETFs trend upwards over time because they hold hundreds of companies, and when one struggles, others balance it out until it recovers. And finally, don't try to time the market. There's this old Seinfeld episode where George Costanza, known for coming up with these elaborate schemes, decides to do the opposite of all of his instincts, and suddenly everything in his life starts going right, turning that into what investors jokingly call the Costanza strategy. When people tried doing the opposite of their gut feeling, like buying when stocks were high instead of waiting for them to drop, they found that even the so-called worst timing often led to strong long-term results. So the lesson here isn't to buy high or low, it's to keep buying consistently no matter what the headlines say. Because the truth is, no one can predict the market. The only thing that you can control is how consistent you are with investing. If you follow everything I've shown you today, you'll start investing earlier and more effectively than I ever did. And honestly, if I could hit redo, I would invest far more aggressively from the start. But since I can't, I'm glad to share what I've learned and hopefully save you a few years of trial and error. And if you're ready to take the next big step with investing, I highly encourage you to join my next beginner's investing class here.